Hello everyone. Today we will be looking at the S&P 500. Let's start by looking at the institutional positions on what the hedge funds or banks are doing. These are large speculators in the markets, but today I'll start by explaining how this spreadsheet works. The first column has the dates of when each report was released, followed by the column of the total longs the banks are holding, then the total shorts. The change longs and change shorts columns tells us how many contracts the institutions added or closed that week. The total column is a sum of both longs and shorts positions the institutions are holding in that particular asset. The longs and shorts percentage calculates the percentage of the total longs or shorts that particular asset have. Then we have the net positions in percentages and net positions in number of contracts. The net position is the difference between total longs minus total shorts. If the number is positive, it means they are more bullish. If the answer is negative, it means they are more bearish. But bear in mind that the net positions are long-term. You cannot make your decision based on whether they are net long or net short. Hence, the next columns are very important. We have the net positions change columns of the year, 3 months, and 1 month. These columns are calculating changes from the previous year, quarter, and month. Right now, if we can look at the year. Compared to the previous year, the institutions added 129,231 net positions, which means they were very bullish almost the entire year, which was 67% increase. This doesn't mean that the whole year they never held short positions. It just means they were more long than short last year. Looking at the 3 months column, we have net short of 28,363. Does this mean we should see the 3-month candle bearish? No. The question is why. If we can look at the month of October, the institutions were net long with 104,497. Then, in November, they were net short 138,723 positions. And this was not because the institutions were accumulating shorts. They were just closing longs, just taking profits. Let's investigate the November month further. On the 12th of November, they closed 14,054 longs and added 72,868. This week alone, they did add short contracts, which resulted in a pullback that particular week, and the candle resulted in closing bearish. The following week, on the 19th of November, the closed longs of 12,792 and also closed shorts of 21,584. That week means they only closed positions and never added on either side. Following week, they closed 77,967 contracts and added a little bit of shorts, which made the total of net shorts on November to be negative. That does not mean they were short that month, just that they closed a lot of longs, securing their profits. That is why following month they began adding more long positions. December alone, they added about 5,863 net longs. And it was not because they were just closing short positions each week, but they were actually accumulating longs, which is more significant because net longs or not shorts that are caused by only the closure of positions are less impactful than those that are caused by adding or accumulation of positions. Now, don't just look at the institutional positions, then go to the chart and start opening positions. After analyzing this report, make sure to then go to the chart and look for setups using whatever strategy you are using to align yourself with the institutions. If you see the institutions closing their longs, yet the chart is still going up, just also prepare yourself to taking profits. Don't add more longs while they are closing their longs. Wait and see if after taking their profits, are they going to start accumulating shorts, or they will reload new long positions. Then, you can start adding positions too. Now, let's go to the chart. Let us start at the yearly chart. Look how massive the yearly candle is. If you have been following the institution since the beginning of 2024, it means you would be smiling all the way to the bank at the end of the year. This year, I'll be looking to first trade towards last year's highs as my first target. Let's look at the quarterly chart. As we can see, previous quarter we closed bullish. If we drop down to the previous month, we can see that as price was going down, the intuitions were accumulating longs, which means the sentiment of this asset is still bullish. That was just a pullback. Now, dropping down to the daily chart to investigate this further, I'll use the two-legged pullback theory. We can see that price pulled back. Now we had the first attempt to go long. We pulled back. Now second attempt to go long. We should resume the uptrend now since the two legs going down is complete. We had first leg down, pull back, and second leg down, and we failed to create a new low to start a new downtrend. In my opinion, we should start going long if we trigger above the previous day high. If you're an ICT trader, Nasdaq swept this low creating SMT divergence. I'll leave the entries up to you with your own strategy. Don't forget to leave a like, comment, and subscribe if you found this video insightful.